Hello everyone, and welcome to this week's CLiK Trading Education weekly market summary. I'm Iftikhar, and over the next few minutes we'll review what happened across the financial markets during the week ending the 24th of July. We'll cover the major market movers, explain what drove price action, examine the technical picture across the main asset classes, and finish by looking ahead to the key economic events that could influence the markets next week. As always, our aim isn't to predict where the markets are going. Our aim is to understand what is driving them so we can make informed trading decisions based on probability, discipline, and sound risk management. So let's get started. This week saw a noticeable shift towards a more cautious market environment. After several weeks where technology stocks had led the market higher, investors became more defensive, reducing exposure to many of the high growth names. The Nasdaq was the weakest of the major US indices, losing around 1.6%, while both the S&P and Dow Jones also finished the week in negative territory. In contrast, commodities enjoyed an exceptionally strong week. Crude oil surged by almost 8%, silver gained over 5%, and gold also moved higher as investors sought protection against ongoing geopolitical uncertainty and inflation concerns. The US dollar strengthened modestly, reflecting the market's more cautious tone. Meanwhile, cryptocurrencies were relatively quiet, with Bitcoin ending the week slightly lower and Ethereum remaining largely unchanged. Overall, this week's price action suggested that investors were becoming increasingly selective about where they were willing to take risk. The biggest market moves, the standout performer this week, was undoubtedly crude oil. Prices rose by more than 7%, driven primarily by renewed geopolitical tensions and concerns over future global supply. Whenever uncertainty surrounds oil-producing regions, markets often react quickly as traders begin pricing in potential shortages. Silver was another impressive performer. The precious metal benefited from both safe haven buying and expectations that inflation could remain elevated for longer. At the opposite end of the market were the technology giants. Tesla experienced one of its weakest weeks, falling almost 19%. Alphabet lost nearly 9%, while Meta declined almost 8%. Although each company had its own individual factors influencing performance, collectively, these moves reflected investors becoming more cautious towards highly valued growth stocks. One important lesson for traders is that markets constantly rotate. Money rarely leaves financial markets completely. Instead, it often moves from one sector into another. Recognizing those rotations can provide valuable context when planning trades. What moved the markets? Several important macroeconomic themes influenced markets this week. Inflation continues to dominate investor thinking. US consumer price index data came in slightly above expectations, reinforcing concerns that inflation remains persistent. Producer price index data also suggested that pricing pressures within the economy haven't completely disappeared. For traders, inflation matters because it directly influences central bank decisions. If inflation remains stubbornly high, interest rates are likely to remain elevated for longer, which tends to create additional pressure for growth stocks. Across Europe, manufacturing activity continued to slow. That weighed on the euro and contributed to further strengthen the US dollar. Central bank communication also remained relatively hawkish. The Federal Reserve repeated that bringing inflation under control remains its primary objective. Meanwhile, the European Central Bank maintained a cautious, data-dependent approach. These differences in monetary policy continue to play an important role in driving currency markets. Geopolitical developments. Geopolitical events also played an important role this week. Renewed tensions in the Middle East helped push oil prices significantly higher as traders considered the possibility of future supply disruptions. At the same time, continuing trade tensions between the United States and China added another layer of uncertainty across global markets. Events like these remind us that markets are influenced by far more than charts alone. Understanding the broader macroeconomic environment helps traders place technical analysis into context and better manage risk. Technical market outlook. Turning to the charts, several interesting themes continue to develop. The major US equity indices remain under pressure. The Nasdaq continues to show the greatest weakness, with price now approaching important support levels that traders will be watching closely over the coming weeks. Gold and silver both continue to maintain constructive bullish structures. Their recent strength reflects increasing demand for defensive assets alongside continuing inflation concerns. Crude oil remains firmly in an established uptrend following this week's impressive rally. The key question now is whether buyers have enough momentum to continue driving prices higher or whether profit-taking begins to emerge. Within the foreign exchange market, the US dollar remains relatively strong. Both euro and pound continue to trade under pressure as investors favour the safety of the dollar. Bitcoin remains largely range-bound, while Ethereum continues to consolidate without establishing a clear directional trend. As always, technical analysis isn't about predicting certainty. It's about identifying high probability locations where buyers and sellers are most likely to become active. Looking ahead, next week contains several important economic events capable of increasing market volatility. The biggest event will undoubtedly be the latest Federal Reserve meeting. Markets will be paying close attention not only to any policy decisions, but also to the language used during the accompanying statement and press conference. Friday's US non-farm payrolls report will also be closely watched as it provides one of the clearest indicators of labour market strength. We'll also receive US housing market data, Eurozone GDP figures, US initial jobless claims, China's manufacturing PMI. Each of these releases has the potential to influence currencies, commodities and equity markets, depending on how the actual results compare with market expectations. Remember, markets often react more to surprises than to the numbers themselves. Trader takeaways. So what are this week's biggest lessons? Firstly, market leadership can change very quickly. Technology stocks weakened while commodities became the strongest performing sector. Secondly, inflation remains one of the biggest drivers of financial markets and continues to influence central bank policy. Thirdly, the US dollar continues to benefit whenever investors become more cautious. Fourthly, geopolitical developments remain an important influence, particularly within energy markets. Finally, remember that consistency in trading doesn't come from predicting every market move. It comes from following a structured process, managing risk carefully and waiting patiently for high quality opportunities. That's exactly the philosophy we teach at CLiK Trading. Thank you for joining me for this week's market summary. If you found this update useful, please like the video, subscribe to the channel and share it with anyone who wants to improve their understanding of the financial markets. If you'd like to learn more about our structured trading education, mentoring programs and live market support sessions, visit us at www.cliktradingeducation.com. Until next week, trade well, manage your risk, stay disciplined, and I'll see you in the next market update. Take care.